Hi, I'm Steven Van Metre and welcome to your Thursday night premiere. This is a special edition where we try to make sense of what's going on with the Fed. There's so much misinformation out there. I've practically had to shut everything off and stop looking and listening to what people are saying. They're literally breaking down, oh look, the Fed changed this word here, that means they're going to hike next month. No, I analyzed their speech and they said this thing 4 times, and so that means they're going to do this. Look, let's be very, very clear about things. The Fed does not know what they're going to do next month. They have no clue. And the notion that people believe the Fed knows is completely false. So let's try to understand what is actually going on and why it's not what you think and why the market is reacting to something that may not even be relevant at all. Because the most important thing is, as of yesterday's press announcement, nothing changed. The Fed did not raise rates, they did not lower rates, and they did not change their balance sheet unwind. They didn't do anything. All they did was suggest that they might change rates, but they didn't say how much or when. So what's the real deal with the Fed? The Federal Reserve, while they have some congressional mandates that they have been given that they actually cannot achieve, but they still try, the Fed, a central bank such as the Federal Reserve, their goal is one thing and one thing only: to prevent the inflation of dollars or whatever the currency is of the country, because these are pieces of paper. That is what they actually are, with printed ink on them. And yes, they're expensive printed pieces of paper, but they are printed pieces of paper nonetheless. The only reason you and I agree they have value is because we agree they have value. If we stop believing that these have value, they revert to a simple piece of copier paper. Actually, they may be worth less than that, because I can't really use these if nobody thinks they're worth anything. So the Fed's job is to make sure that these things stay around. And that is why you'll see things like the full faith and credit of the Federal Reserve. It is the full faith. They say this is money. You say it's money. I say it's money. We all say it's money, so it must be money. The moment we all think it's not is the moment it stops being money. So the Fed's goal, as always, is to keep too many of these things from sprouting up. I don't have a whole lot here, mainly just ones and I think a 5, mainly to keep these things from multiplying too quickly to becoming worthless. That's all the Fed's trying to do. So the notion that the Fed wants to lower interest rates all the time is false. The notion that the Fed wants to run up their balance sheet all the time is also false. The Fed's job is to stop inflation, or more specifically, as we would look at in modern day, to control the rate of inflation. Of course, their definition of inflation today is price increases, but in actuality, the definition of inflation is the increase in the money supply of a fiat currency. Now, in an ideal situation, the Federal Reserve would prefer to have a balance sheet significantly smaller than it is today. So rather than having one that was a little over $4 trillion, they would be very, very happy if it was under $1 trillion right now. They would be thrilled. I know it doesn't seem like that. They'd love to. It just doesn't work. They can't seem to do it. They would also prefer to have interest rates much higher, say 5, 6, 7%. They would love that, because it gives them room to ease when there's a problem, and higher interest rates do tend to control inflation. So in an ideal world, that's what the Fed wants, because the longer the Fed stays at zero and the more balance sheet they add, and although right now they are unwinding, the more they add, the more they fear that inflation is just going to grip its ugly head and poof, overnight, these things are going to become worthless. That's what they're afraid of. So the Fed has a lot of policy tools. In fact, this weekend I read, as I mentioned in last night's video, I read a wonderful paper that is rather confusing, but it did have a lot of interesting comments in it that these researchers went through and said, look, when the Fed does this, this is the range of market reactions. When the Fed does this, this is a range of reactions. And so they were trying to figure out, given all the policy tools the Fed has, which ones are more effective and how they should handle them in the next recession. One of those policy tools is flapping their lips, called forward guidance, or putting Fed speakers out to give speeches or talks and discuss monetary policy and outlook. See, the Fed believes that if you and I are afraid to spend money, that we will stop spending money. And that is true. If we think there's a recession coming or we think bad things are coming, consumers generally stop spending. And in a debt-based economy, it's the last thing that you want to happen. In a debt-based economy, what you want is people borrowing and spending in perpetuity at larger and larger amounts, so that way the Fed can control the rate of inflation. That's what they really want. So what did the Fed actually do yesterday? They lowered interest rates without lowering interest rates. That's what they did. And the reaction in the stock market today is a perfect example. Stocks were up, bonds were up, gold was up, oil was up, everything pretty much was up. Now, why does the Fed want that? Well, there's very simple. There's something called the wealth effect that they figured out decades ago that says the higher the stock prices go, the more people spend. They feel rich, they go out and spend. Now, since about half of Americans don't really own stocks, it doesn't apply to everybody, but the general idea is true. And the Fed certainly believes in trickle-down economics, where my spending becomes your income and your spending becomes someone else's income, and eventually that flows back to my income, and it's a nice big circle. That's what the Fed believes. So, what did the Fed do? All they did was say we might lower interest rates at some point in the future if conditions warranted. What conditions we're not going to say, when we're not going to tell you, and how much we're also not going to mention. And to make sure you're completely convinced of that, we're going to change our press release, the wording of it. We're going to have about half of our committee members want a cut, half the members want to stay the same. Maybe one or two people wanting a hike and one or two people wanting an even cut today. That's what we're going to do, because we're going to send you the message that, hey, we're here to fight that fire. We're here to keep the economy going. And what is the reaction to that? People bought stocks. And maybe some people today went out and bought a house or bought a car or hired a new employee. See, the Fed knows that. So what they're going to do is they're going to talk the markets up as much as they can, so they don't have to lower rates. Now, if you don't believe me, go back and look at how long we were at the zero bound after the great financial crisis. How many times were there Fed meetings that Janet Yellen said, oh, we're going to go up a quarter. We're going to go up a quarter. Oh, no, not this time. We're going to go up a quarter. Nah, gotcha. Maybe next time. And it wasn't until her final meeting, which is not unusual for Fed speakers, that she raised interest rates 0.25%. Because the data didn't say they should. So right now, the Fed doesn't think the data is bad enough to lower interest rates. They know economies are cyclical a bit. They understand that the trade wars are causing a problem. And they know the moment the trade war is over, that should normalize things after some point in time. How long, I don't know. And they probably don't either. But I want you to understand, they successfully lowered interest rates yesterday without lowering interest rates. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that I'm on do not reflect the view of Atlas Financial Advice Inc. or Steven Van Metre Financial. Now, why was everything up today? That's a big question. Was it because of the Fed? I don't think so. Tomorrow is quadruple witching day, where you have a lot of option contracts and futures contracts expiring, meaning there's a lot of money and shares trading hands. Winners are going to get paid, losers got to pay. There's going to be a lot of trading volume going on as all this happens. So here's the deal. If you put a price target, say you bought an option and it's not in the money until the S&P hits, some number, and we're 10 points off it, and you're a big money manager, rather than lose money, what you're going to do is you're going to come in there and jam as much, whatever money you've got left, whatever leverage you can do, and you're going to shove that market higher, or try to, so you can profit on that option contract, and then you're going to dump your positions, potentially depending on what the market does. So that is not an unusual move the day before quadruple witching day. So that's what's going on. So let's take a look at some charts. I didn't set a time limit on today's presentation because I wanted you to understand what's going on with the Fed. I don't know that they're going to hike next month. They may not. In fact, if enough people go out and spend, they're not. Or let me cut next month. I mean, they could hike. I mean, if inflation takes off, they could be in a position to hike. All right, so let's look at the S&P 500. All-time new highs today, despite news coming out of the Philadelphia manufacturing sector from the Fed survey that said conditions are deteriorating and this just following the New York or Empire Fed survey that shows manufacturing conditions are deteriorating, but that is not stopping investors who think a war with Iran is bullish and a Fed rate cut is bullish and everything is bullish because everything is bullish. So there you go, new all-time high in the S&P 500. Treasury yields also went down. So it's very unusual when you see stocks and bonds go up in a day. That's not normal. Normally when stocks go up, interest rates should go up or bonds should go down. And when stocks go down, you should see bond prices go up or interest rates fall. So this is also unusual. Let's take a look at gold too. It was up today and had a lot of excitement as people are now chattering that this is that big monster breakout. I'm not 100% convinced. We have to go to the weekly chart to fit this entire pattern in here. Okay, so the real story is this thing's got to actually get above 1400. My green line is not technically in the absolute correct spot. It's just based on the closest average. And so really, in order for this to be a true breakout, gold prices need to get somewhere between 1400 and 1425 is where they need to get to break out. Now, I want to show you again that Wyckoff pattern, and let's zoom this in a little bit, and then I'm going to switch over real quick. All right, here you go. Here's the double bottom pattern. Prices come down. They come up into a supply zone or overhead resistance. They sell down to support. They find buyers there. They oscillate, break through resistance, make a new interim high, come back, find support against that supply zone, make another high close to where the breakdown in prices was. This gets people very, very bullish. Then they sell down back to the original supply zone. See, it says absorption of supply, so back down to the original level of resistance until all the supply is chewed up and then it takes off. That is a Wyckoff double bottom. Usually volume down here is rather light. All right, so keeping that in mind, let's look over here at the chart. We'll zoom this in a little bit. So gold comes down, makes a bottom, or a couple, bounces around, makes some bottoming here, goes up, crosses through resistance. Now, I could be wrong about where this is. I just drew this in. These are my lines, not, maybe not the correct place to put them. So it comes back up here, pulls back down, did not get down to support, and then is now making a higher high. Now, remember, I said this was probably going to happen or could happen. That, hey, this is not unreasonable. If this is rejected, then we should see it come back down to roughly 1200. That would complete a Wyckoff double bottom. Now let's take a look at the different mining stocks and see this. We get a little cleaner picture here. We'll zoom out. This is the large gold miners. And we'll zoom this accordingly. So here's your move down. This is the top end of your range. Until things break out of here, you've got a whole lot of nothing. So here's a move down coming into the double bottom. Bottom. Okay, so we got a nice double bottom of price in here after the waterfall down. The first move comes up to kind of right underneath the original waterfall. Now you could also look at this as a downward move, even though it's sideways. You can interpret it that way. You see another move, comes back down, holds support, another move up to resistance. So right now stuck here, comes back down, finds support, which should have come down to, this is the correct spot, should have come here, and then bounces up here. If this is rejected, it again suggests that down here in this $18 to $19 price range is where the large gold miners should create their double bottom. That's what we should see. And notice there's a lot of volume. There's also these gaps, and I'll zoom in so you can see those. See these gaps? Generally, these gaps need to be filled. They don't always get filled, but they generally mostly get filled. So that tells us that we should see a reversal in price back down to here. Odds are this move is too quick, it's too fast, it is not a breakout move. Let's go look at silver miners. Do you see them coming up to their prior level? Not even close. So silver miners would need to be way up here. Now there's another important thing that I should mention to you, is that miners always lead the metal. It's very, very rare that the metal leads the miner. So the fact that we're seeing the metal lead the miners, it tells us something's not exactly what we think it is. Let's look at the junior miners. Make sure you can still see that. Good. Okay. Here's the junior miners. And what we can see is they have not even eclipsed that high here. So they should be way up here to validate that. So again, I'm really not seeing this as the, oh my God, breakout and buy gold. Now, if it happens to be, the good thing is the miners are all lagging. So there's plenty of latitude in here to get in and take advantage of it. But at the moment, we're not seeing that. Let's take a look at what I think is going on with the long bond, with the 30-year Treasury. We're going to reallocate the legacy portfolios into this, not just yet. And here's what I think is going to happen. I think we're going to see rejection up here at this level. I think we're going to see sellers come in, and notice the 50-day moving average, which this thing tracks really well. I went back and looked at it. Some things track the 50-day, some like the 100-day. This tracks the 50-day pretty well. And you can see across the 50-day, bounced off it, and bingo, it's up here. Now notice how the 50-day is rising into this, I did tweak this big broad resistance zone. So what could happen is we could see prices come back down to this 128 level and catch right up with the 50-day moving average. Kind of like it did here. You see prices got a little excited, people want to buy, and then it comes back down, reconnects with the 50-day moving average, and goes. I think that is a very high probability, mainly because this is a pretty strong area of support, and odds are it's got to be retested. I mean, there's a good chance. I mean, would be pretty unusual at this point. Even on the last surge of the bull market in bonds, you can see it tested this level 3 times. So chances are it's going to do it again, but you can see both the 50-day, 100-day moving average, which it also likes as well, are both rising. And if it can hold all of this area and then break through this resistance at a later date, then you have a run at the all-time high, and you've got a bull market in bonds sitting right there in front of you. Let's take a look at crude oil. Again, everyone's going crazy about crude oil despite inventory levels being at a 2-year high because Iran shot down one of our drones, as if that is going to drain a 2-year supply of oil. I don't get it, because we generally do not fight big intensive wars anymore when we have missiles and other things that we use these days. And last I checked, Iran does not have a substantial army to begin with. So nevertheless, people were very bullish about oil today, despite inventory building. But look what happened. All it did was get into this little level of support. It broke through support, and people went up. Now, why would you expect this to happen before quadruple witching day? Because you've seen how many people are bullish on crude oil. Odds are they bought options or futures contracts in here, betting that oil prices are going higher. Chances are some of those positions are losing money, so they've got to bid this thing up. And it will be rejected here because crude oil follows 5-year Treasury yields, and 5-year Treasury yields are breaking down their support and looking like they're heading lower. I suspect they'll come back up and connect on the bottom of this and then eventually resume their move down. So 5-year Treasury yields are saying, sorry, crude oil, you're going the wrong direction. So we know that's the likely outcome. All right, so let's see. I think that's what I've got for you today. We'll be back Friday, of course, with our deeper update. But I really wanted you to understand that a lot of the stuff you hear about the Fed is highly opinionated. Most people do not study what a central bank does. They just try to fit whatever they want into the narrative that they're selling to their clients, selling in their newsletters or research subscriptions, whatever it is they're selling. And right now, everybody wants the Fed to cut, but they might not. I mean, a lot of people thought they were going to cut yesterday, and they didn't. Why? Because retail sales popped up. Yeah, there's global concerns. Gee, the trade war is a problem. That's the way it works. But if American consumers keep spending, it's not going to be a rate cut. Inflation could spike up. We'll see. And if that's not good enough, Last night, several other foreign central banks made the same move. So it tells you they're all in the same boat. They think the trade war is going to come to an end and inflation is coming back. I'll see you tomorrow. Bye now.